If you are a dividend investor, your hopes with investing long-term using compounding can put you in a big financial hole if you don't pay attention to the investing details, which we are going to discuss in this video. Hi, I am Henrikh from Value Investing, and today I want to cover the pros and cons of dividend investing, and mostly I want to state a few major problems of dividend investing and want to compare that part with value investing. That's a fact that many people need steady cash flow from sources like dividends, and that's maybe the most important part of dividend investing. But many times people waste their wealth blindly following the idea of a steady cash flow. So when your main focus is the periodic cash flow like monthly or quarterly, that doesn't mean that you must keep the asset value part. For example, if you buy a $100 stock and you get $5 annually as dividends, while losing your asset value part with decreasing stock prices and destroying your wealth, that's for sure not a good investment. Okay, now if you want to be a very good dividend investor, you must make sure you are investing in a very good company that the stock price is not going to drop in the long run. In other words, you must fully investigate and analyze the company numbers, and not only the numbers, to make sure that the company is a great one and it is going to grow in the long run. Many dividend investors blindly follow the yield size that is almost promised by the company or the CEO of the company. But very often companies have big difficulties paying those dividends, which are almost promised earlier. And by paying those dividends, they don't have enough resources to invest in growth, so they lose their upside potential. Usually companies keep paying those dividends even if they finance those dividends with new debts, or even if they are loaded with too much debt. There have been some cases that companies even paid those dividends before they finally crashed. So this means when companies start paying these dividends, they agree to have that mandatory expense, because if they stop paying those dividends, they will lose their status. Many dividend investors think that is a good thing and they will benefit from it, that companies will pay their dividends no matter what happens. But let's go deeper. Do you really want to increase the pressure on your own company? Do you want to make extra difficulties for the company you own? Do you want your own company to have many obligations, or you want to let it grow easier? Sometimes those obligations make companies crash. So the main question is, are you in the same team with the business managers, or you are against them? Remember, if you need guaranteed paycheck, you maybe better invest in bonds or CDs or other guaranteed type investment tools. So to pick up a good company, you must fully investigate the company, love it, and believe that it will grow in the long run. Then you must value it, and if your paying price is less than the real value of it, you want to buy it. Valuing the company is based on the underlying business, not based on the yield size, which is the next problem of many dividend investors. Many beginner dividend investors focus on the yield size only, but they forget that the dividend cut is not that rare thing in the stock market. And when it occurs, many investors sell their stocks because of the less yield, and the stock spirals down even faster. And companies are having bigger problems and cut their dividends even further. Thus, you must know your company's financials well enough that it will not have difficulties and struggles to pay your dividends. This means you must value it ideally, or almost ideally. Please notice, while doing this deep analysis and finding the real value of your company, you are becoming more like value investor rather than dividend investor. Because if you believe your company's future is bright, you will want to leave the money with them rather than taking the money from them periodically. Also, you will skip the dividend taxation part, so more money will stay on your company's equity rather than government's equity. By the way, by saying a value investor, I mean like Warren Buffett type of investing, the new modern way of value investing, not the old way like finding cigar butt companies. At the end of the day, the only reason you will want that cash flow to your pockets via dividends is when you need to spend on your living expenses, and that is mostly true when you are older than younger. Because when you are young enough, it is better to invest in your financial growth in the long run and surely have another income source for your living expenses like job, personal business or something else. Also, even if dividend investing is more of your type of investing, please pay attention when you start your dividend investing journey, because starting on 2020 can put you in a big trouble, as the market is way far from being undervalued or even being fair valued. As of many reasons, like S&P 500 total PE ratio is too high compared to its historical numbers, interest rates are at historical low, dividend yields are at historical low. The S&P 500 total dividend yield was more than 13% in 1932. Now it is less than 2%. The historical range was between 3 to 5% for S&P 500. I would say the reason behind this low dividend yield is more connected with prices than dividend itself. And investing in stocks and losing the asset value while being a dividend investor is as wrong and dangerous as being a value investor, a growth investor, or any type of investor. So starting investing in dividends when the market is crashed might be a very good investment, as the dividend yield size will be high enough together with stock price appreciation in the long run. But again, we must not forget to invest in only wonderful companies which we can value and predict better. And to select them, I would go deep in value like value investors do, rather than focusing on dividend size or steady cash flow or such things that most dividend investors like to mention. Of course, nobody can time the market, but even if the market goes up always in the long run, that long run is about 50 or 100 years, because there have been many cases in the history that market went nearly nowhere for 10, 20 or even almost 30 years. And in this case, if you invest only for dividends using today's average under 2%, that will not give you the advantage against savings accounts, bonds or CDs, because they also offer that under 2% cash flow and they are more risk-free than investing in stocks. So at the end of the day, if you still prefer stocks to bonds or savings accounts, this means you are betting against inflation and you want to benefit from equity appreciation while being a dividend investor. So if we cut out that equity appreciation part from your strategy, you would not prefer dividend stocks to savings accounts, which means the growth of your stock prices is one of the most important part in your investing strategy while being a dividend investor. Oh, by the way, these are my favorite top 10 books about stock market investing. If you don't have any of those, you definitely need it on your bookshelf. To ease your job, I put the Amazon link in the video description where you can go and grab it with just one click. If you want to expand your skills in this sphere, those are the most valuable books about stock market investing. You can learn a lot starting from Benjamin Graham, the father of value investing, going to Warren Buffett, Phil Town, the Rule 1 investor with his daughter Daniela Town, Guy Spire, Peter Lynch, the 29% guy, Jason Zweig, one of the greatest minds, Robert Shiller from Yale University, and of course Andy Tanner from Rich Dad Education, founded by Robert Kiyosaki. These books include both easy reads and hard reads for beginners and also for pros. Reading all those books will put you in a big advantage in the stock market. Go buy them for you and for people whom you care about. The links are in the video description. Another thing I want to cover is the US inflation rate. The official historical numbers are about 2-3% within the last 100 years. In my opinion, the real inflation rate is way higher, But let's play around with the official numbers. If your investments don't grow in value, but will only provide the 2-3% cash flow, you are not going to live a better life because the inflation rate is almost the same nowadays. The money you'll get after selling your stocks plus 2-3% dividends will buy you the same things they buy now if the inflation rate stays the same 2-3%. And I'm not talking about the hyperinflation times, which we have the risk always to come. So you better be sure that your selected company will rise in value in the future, and you better use the margin of safety strategy to be safer in your investing journey. By the way, you can find a lot of information about margin of safety in my other videos. To sum everything up, I would say that even if you want to be a dividend investor, you must partly or mostly be a value investor. You must know the exact values of your selected companies. Please take into consideration I am not against dividend investing. I just not agree how most people understand it. If used properly, dividend investing could be a very good strategy. Now I mostly want to know your thoughts, if in this case you are more dividend investor or a value investor. Please leave your comments below and don't forget to explain why you need that steady cash flow, if not for living expenses only. Anyway, you are going to reinvest it, and when you reinvest you will choose the companies you already love. Maybe you can grow your wealth faster with non-dividend companies. Leave your comments below and subscribe and hit the bell icon to get notifications when I upload a new video, so that you don't miss it. And if you could take any value from this video, please hit the like button and share with your friends. Thanks for watching, have a good day.